So good afternoon, everyone. Thank you for joining our webinar on the recent budget. Many of you do know us already because I can see lots of familiar names on the delegate list. But for those of you who don't, we're leading accountants and advisors to the media industry, working with clients across the marketing services, film, TV, theatre and media tech. And we've got about 100 media specialists working, well, either at home or in our Tottenham Court Road offices, the clients that we work with range right from privately owned entrepreneurial businesses through to internationally backed private equity groups and AIM-listed companies. We're part of Moore Kingston Smith, which is a top 15 audit, tax and advisory firm, and in turn that's part of More Global, which is an international network with presence in over 100 countries, so very well placed to help our clients as they grow internationally. And today we're going to be talking you through what happened in last week's budget. So if you're expecting anything else, then you're in the wrong place. So what happened last week and also what Rishi might have in store for us going forward. So I'm delighted to introduce Mike and Mel. Mike Hayes is probably the more familiar face among the two. He's one of our tax partners who works very closely with our media clients and has been with us many years. And no doubt you will have seen him talk at lots of events previously. And he advises regularly on business structures, corporate transactions, share schemes and CGT planning, and also spends quite a lot of his time advising UK and US businesses on how to do business in the other country. And this might be the last time that Mike does a budget webinar, so I hear he's got a little bit of an amusing reminiscing to do for us at the end on tax rates when he was a bit younger than he is now. So Mel Reed will be the new face to most of you. So Mel joined us as a partner earlier this year, having previously been head of corporate tax at a top 10 firm, and she specialises in advising entrepreneurial businesses even throughout their whole life cycle, right through to their exit and sale. And she's also got significant experience in advising private equity and AIM listed companies as well. So we're split today into three parts. We're going to sort of broadly look at entrepreneurial and creative sector tax reliefs. Then Mel's going to look at corporate tax, and then back to Mike for a look at some private client stuff. A little bit of housekeeping. We will be circulating the slides after this webinar, so please do share them with your peers, anyone who couldn't make it today. Please do complete the survey at the end. Always interested in your feedback. It's really quick and it's really short and really valuable. And there will be time for questions. Please do give us questions. Please do pop them in the Q&A function, not the chat function, though much easier to keep track of them in the Q&A function. And I'll either put those to Mike and Mel at the end, or maybe weed them in as we go through, depending on what the questions are. So without further ado, I will hand over to Mike, who's going to kick us off.
Good afternoon, everyone. Just try and get this sorted out. Does that look fine?
Yeah, that's good.
Right. Good afternoon. I hope you enjoyed this presentation. Let me just start us off by just going through the things that I want to talk about today.
Mike, I'm not sure you have got it on presentation view, actually.
Haven't
You've got
I?
it on preview, the next slide as well.
It should be on the right view. So what are you seeing, the main screen or not?
Seeing the main slide and the next slide as well, and any notes.
All right, okay. Well,
not the end of the world, but
no, let me just see if I can actually change that. Display. Is that better?
Yeah, that's much better, yes.
All right, it's the opposite way around this morning. Anyway, so this was Rishi talking about how he's starting the work to prepare for a new economy post-COVID. Well, let's have a see at sort of the things that he's talking about and what he's going to do. As Esther said, that's the sort of structure. So I'll start off talking about some corporate business stuff, mainly for entrepreneurial businesses, and then we'll go on to Mel and then back to me for personal taxes. So corporate business taxes, part one. Not much to actually say at this point. Last budget, Rishi announced that corporation tax will go up to 25% from the 1st of April 23. I had hoped, and I'd had a sort of an idea that he might actually just come back from that and keep the corporation tax rate as it is. But no, he's reaffirmed that increase. It still doesn't mean it's not too late to change it. So, but he reaffirmed that change. So we are looking at a corporation tax rate for larger companies with profits over £250,000 from April 23. For smaller companies with profits up to £50,000, the tax rate remains 19%. And if your profits fall within those two bands, in other words, your profits are say 150 because they fall within 50 and 250, you actually pay 26.5% on the margin over the £50,000 profits. So, and also bear in mind that those limits are actually divided by the number of companies that are associated, which normally means companies under common control. So that was reaffirmed. Banking surcharge, just to mention very briefly, the current rate of banking surcharge is 8%. That's coming down to 3% from the 1st of April 23, which means that when you combine that with the rate of corporation tax going to 25, the combined rate will be 28%, and it's currently 27%. I suspect Rishi thought that a combined rate of 33%, which it would otherwise be if he didn't reduce it, would actually be a bit much for the banks to swallow. Question has to be asked, I think, as to whether the UK has a competitive tax regime. I mean, he made reference to this in his speech because it's obviously a thing playing on his mind. And he said, we've still got the lowest rate of corporation tax in the G7, even with 25%. And it's the 5th lowest rate in the G20. On the other hand, if you look at the International Tax Competitiveness Index for 2020, which is the last year we got results for, we ranked 22nd in the world, which is one worse than 2019. And that's before 1.25% NIC increase, which was announced a month or two ago. So I don't think this is anything for Rishi or the government to be complacent about. We are in a good place. We are ranked as the 8th best jurisdiction to do business in the world. And we do have some really good tax incentives. So even though the corporation tax rate is going up, we have good incentives for creative sectors, research and development. We have the new free ports coming online. So there are lots of things that make the UK still an attractive place to do business. But as I say, it's not something you can be complacent about. What does the increase in corporation tax rate mean for taking cash out of your business? It's a question we get asked frequently. At the moment, if you take money out as a dividend rather than a salary, you're going to get a saving overall of between 3 and 4%. In 23-24, basically there's no difference. So it's very, very marginal. If your profits fall in that 26.5% rate, then it is going to be better to pay a bonus because you're saving more corporation tax. But even that, I think, is going to be quite marginal. Just remember when you're deciding that salaries and what to do, salaries and bonuses affect the gender pay gap reporting, and dividends don't. So it could have a knock-on effect elsewhere if you decide to take salaries rather than or dividends rather than salaries. I'm going to move on to the creative sector tax reliefs. The creative sector has generally had a mixed experience throughout COVID and the lockdown. Certainly those types of creative sector which require personal attendance, for example, museums, galleries and theatre, have obviously suffered because they've been completely closed. The scene has been a bit different for those that you can actually access at home through film, TV, video games, etc. So let's talk about the changes. He's made some significant changes, so let's just mention those. So on the museums and galleries exhibition relief, the current rules have a sunset clause, which means that the relief was going to come to an end at the end of March next year. Well, it's been given an extra 2 years of life up to the 31st of March 2024. Whether it will continue beyond that, I don't know, but clearly he's hoping that another 2 years of tax relief will help museums and galleries get back on their feet, because obviously they've been largely closed over the last 18 months. The government have said that they're going to clarify some of the relief rules. They don't say which ones. There's going to be a finance bill published on Thursday, so maybe we'll get to know. Clarification can sometimes be a positive thing or a negative thing, depending upon which way they clarify them to be less generous or more generous. But they do say it's going to make it easier for touring exhibitions to claim the extra tax relief for touring. So hopefully it's going to be good, but any clarification of the tax rules has got to be welcome. The most significant change, I think, is that the tax rates or the rates of credit relief have gone up. So I've tried to show it in this table, and these changes only apply for the theatre relief, orchestra relief, and the museums and galleries relief. And what I've shown is the rates of credit that you got before budget day, which is in the first column with numbers. And then what I'm then shown is the rates of relief that apply from budget day onwards up to the end of the 22-23 tax year. And then the 23-24 year, which is a bit lower. And then finally, going back to the pre-existing rates from the 1st of April 2024. And these increases are pretty generous. So, for non-touring theatre productions, currently you get, or you would have got 20% up to budget day. You now get a 45% credit for the next 18 months, followed by 30% for another 12 months, and then back to 20%, and so on, as you can read down the table. So once again, I do think this is Rishi hoping that this extra credit relief will actually help theatres, orchestras, museums and galleries get back on their feet. There were some figures given for the museums and galleries relief from the 1st of April onwards, but I've greyed them out because they've also said that the relief's coming to an end on the 31st of March that year. So maybe that was just an omission on the part of the people who put together the press releases. They think it's going to have a positive impact on 1,200 companies. There are no details of how the rates are going to be applied for 21-22 because we're going to have a change of rates, but I suspect there's going to be some sort of time apportionment for the period before budget day and the period after budget day. As you'll see, there's no increases in film, TV, animation, and video games reliefs. And I suspect the reason for this is that government have probably taken the view that actually some of these have done quite well during the lockdown, because these are things you could consume during the lockdown, particularly people who've been binge watching stuff on Netflix or Disney or whatever else. And clearly video games you'd be able to consume at home. For film, it's been a slightly different issue because cinemas have been closed, but some films have gone directly to the internet. And obviously film production doesn't involve just filming on set. There's lots of other work that could have carried on, like post-production and all that type of stuff. So film was probably hit a bit, but not as bad as theatre, say. Which then brings me on to this. So this is an important sort of set of pictures just to illustrate my next point, and it's not done to be purely gratuitous. So what I'm actually showing here is a couple of films on the left, the Marvel Studios Black Widow film and then Wonder Woman 1984, both of which was designed to actually be released in cinema, but actually went to the internet during the lockdown. And then on the right-hand side, we have Daniel Craig and his last iteration of James Bond, which was going to the cinema, and actually the launch in cinema got put off 2 or 3 times, but they've actually stuck with the launch and actually it has sort of been released about a month ago into the cinema. So why am I actually talking about that? Well, the reason I'm mentioning it is that to qualify for the film relief or the TV relief, which are independent reliefs, you have to have an intention as to where you're going to broadcast those. So for a film, a feature film, you have to have the intention to release that to the paying public in a cinema. And that intention has to be evidenced at the start of the project and at the end of each accounting period. For TV, you have to have the intention of broadcasting on TV or the internet, And in this case, you have to evidence that intention at the very start of the project. And as mentioned with my little picture, some films intended for cinematic release went directly to TV and the internet. Now, what does that mean? Well, what it means is that if the intention to actually move from cinematic release to release on the internet changes partway through the film, then there is no longer any more film tax credit relief. What is more, although you're intending it to actually be released in the same way as a TV program, because you did not have that intention at the very beginning, you don't get any TV relief. So what happened is, because there was a change of intention, there was a complete loss of tax relief in some cases. Now, what the government has said is that they recognise there's more flexibility now in terms of where these things get shown, and it's not necessarily always the case that something that starts off as a feature film will necessarily go to cinema, etc., etc. So what they want to do is introduce more flexibility from April 22. They haven't specified what, but presumably it's going to mean that if you switch intention partway through, you will actually either continue to claim the old film relief, or you then become eligible for the TV relief. Which brings us back to this picture, just to illustrate the point once more. And it was interesting to note that Scarlett Johansson, who was Black Widow, was not impressed with her film going to the internet because it grossed less for doing so, and she was on a percentage. So I think she was going to sue Disney for that, but I believe that they've settled. Anyway, let's move on. Self-employed. I'm going to talk about the self-employed. This is quite an important change. We've had this thing going on for the last few years where the HMRC want us to link our accounting systems digitally with HMRC's own systems. It's called Making Tax Digital. As where we stand today, everything's been converted to Making Tax Digital in terms of VAT reporting. And there is a timescale for moving over for income tax and corporation tax. And I'm not going to dwell on it on the timescale particularly. The timescale for income tax has been put back 1 year, but generally speaking, going forward, you're all going to be reporting your profits and your income electronically to the revenue in due course. Now, as part of that sort of process, the revenue think it would be easier if they changed the way self-employed are taxed. Now, at the moment, if you're self-employed, which means you could be a sole trader or a partner in a business, you are taxed in a tax year based on the profits for the accounting year ending in that particular tax year. So if we look at the year end, the current 21-22 tax year, and let's say you make your accounts up to the 30th of June, the 21-22 taxable profits will be those shown in the accounts to the 30th of June 21. And that's been with us now since about 1997, when we moved to self-assessment. For new rules are going to come into place, and they're going to come into place from the year 24-25. And what's going to happen is, rather than being taxed on the profits in the accounts ending in the year, what you will have is looking at the accounts that overlap the tax year and apportioning those profits into the tax year. So let's take again a June year end, and we're looking at 24-25. So what you will do is you'll take the profits for the year ended 30th of June 24, 3 months of which fall in the 24-25 tax year. So you multiply it by 3/12, and then you will add to that 9/12 of the profits for the following accounting year, as 9/12 of that year falls within the 24-25 tax year. And what you'll end up with is a total assessment using my sort of little bit of algebra of x plus y, and that's how you calculate your profits. The actual calculation would be done on a daily basis, but I've done it on a monthly basis for the purposes of this presentation. And thankfully, we all have software now that enables us to do that. That means converting from the current basis to the new basis, which means that 23-24 is going to be a transitional year. So let me talk about that, because this is going to be quite complicated. So in the previous year, 23-24, we are transitioning from the old accounting year basis to the new actual basis. So what will happen in that year is you'll get taxed on the full profits for the year ending in 23-24. That's the profits for the year to June 23. And then you'll get taxed on part of the following year's profits that actually fall within 23-24. So in this case, it's the year to June 24. 9/12 of those profits will actually fall within 23-24. So you will pay tax in that year on that figure as well. Now, for those of you who have done your arithmetic quickly, you'll begin to realize you're going to pay tax on effectively 21 months profits in one tax year. So sort of compensate for that, what you will get relief for is what's called your overlap relief. Now, your overlap relief is the amount of profits that you would have paid tax on twice when you started to trade or when you joined the partnership or LLP, as the case may be. And that figure should be carried forward on your tax return, and you'll actually get relief for that. So your total assessment for that year will be X plus Y minus Z. Now that's fine as it is, but what you could end up with is a situation where you end up with a bigger profits hit than you might have thought. And I'm putting some real numbers on this. So let's take this case where, say, somebody started this business in 1999, 2000. The likelihood is the profits of the business have gone up. So when you actually plug some figures into this, let's say the June 23 profits are 120,000, we're going to pay tax on all of those. The June 24 profits are 140, on which we're going to pay tax on 9/12 of those. So that comes to 225,000. But the profits were much lower when you started your business, and the profits you paid tax on twice was, say, 9/12 of £60,000. 60,000 was your first year's profits. So 9/12 of that is only £45,000. So that's going to be your deduction. But as you can see, when you actually add those two figures up and deduct the overlap relief, you're going to end up paying tax on £180,000 of profits, which is much higher than the current level of profitability. So this could actually be a hit, in cash flow wise, and it's something you've got to plan for. So if you are self-employed, this is something that you need to be talking to us or talking to your accountants about, just to work out how this is going to affect you. Now, there is going to be some relief from this extra tax that you might end up paying, and there is going to be the ability to spread the extra tax over a 5-year period, which will help cash flow, but you could end up with a bit of a tax shock if you've not thought it through what's going to happen in the future. So that's something to be looking at. The other problem with this is, let's say your accounts are made in December, and we're looking at 24-25 tax year. Based upon the sort of arithmetic I've been using before, you need to take into account the profits in the year to December 2025. But your 24-25 tax return has to be filed by the 31st of January, I should say 26, not 25. Obviously, it means you've got to get your accounts out within 1 month to actually file your tax return properly. Well, that's not going to happen in practice. So you're going to have to use estimated figures for the 25 accounting year and adjust those down the road when the accounts are finalised. So in that respect, it's not going to be a simplification. Now, the rationale for this is simplification, according to the revenue. I don't believe it. It makes making tax digital easier. Well, I think most people in the profession don't understand how making tax digital makes anything easier. So I don't agree with that. It avoids complications at the beginning and the end of the business, which I accept. But one of the things that the revenue were considering was to mandating everyone to have a 31st of March year end. Now, they've dropped that idea, but you wouldn't be blamed for thinking, goodness, this is really complicated. Why don't I make my life easier and change my year into 31st of March? So it's in line with the tax year, and I don't have to put up with all this sort of nonsense. And given that we know that HMRC, like other government departments, have behavioural psychologists working for them, I can't help thinking that it's been made this complicated just to sort of try and encourage people to go to a March year end, which does make everyone's life easier, but it may not be the right thing for your business. Separately, the revenue have considered changing the tax year, but that's still in abeyance, I think. So that was me finished at that point. Do we have any questions before I hand over to Mel, Esther?
We didn't, but it looks like one has just popped up, which says, hi, we operate as an LLP with our accounting period ending on the 31st of March. Would we need to apportion or adjust for a week's worth of profits in 2025 when the new rules come in?
Well, the answer to that is no. HMRC accepts that 31st of March and the 5th of April are the same year end, albeit that there's 5 days difference. So they would actually treat 31st of March as being in line with the fiscal year. They're not going to apportion 5 days profits for that. So that's good news.
Good. I had a question, Mike, on the you said, obviously this could be quite a financial burden to some businesses depending on what your year end is, and quite a lot of LLPs actually have deliberately had an April year end to sort of delay as far as possible the payment of tax on increased profit. So that could be quite a big burden on them. You said that might be able to be spread over 5 years. Is there going to be any restrictions on that? Is there going to be sort of businesses of a certain size can't spread it, or is it everyone can spread it? Or do we know?
We don't know as yet. We need to wait to see the finance bill. I mean, hopefully there won't be any restrictions. I mean, I don't think there were. I mean, this happened when we were all forced to actually include work in progress in our professional accounts at sales values. They had a similar spreading mechanism a few years ago. So hopefully they won't be too restrictive, but we'll have to wait and see.
Good, thank you. And that was it with the questions.
Okay, thanks, Mike, and nice to meet everybody. So I'm just going to pick up on some more of the tax, I say changes, but some of them are just confirmations that that we heard about last week that are more relevant to companies in the main. Some of them affect LLPs and sole traders, but this is sort of more of a corporate section, shall we say. Apologies for my croaky voice as well. So if I need to stop and have a drink or have a coughing fit, then please forgive me. So let's look at research and development. So I guess what Rishi said on Wednesday last week is that the government are really looking to increase spending on R&D as a country as a whole. So this is not just in the form of tax relief, but I think it sort of goes back to Mike's earlier comment about, how competitive is the UK economy. And of course, one of those things that has been around now for just over 20 years is our research and development tax credits. So as a reminder, if you're a small or medium-sized enterprise, if you undertake qualifying R&D work, then you get an additional 130% deduction against your profits for qualifying spend, which is basically salaries and any consumable items that you use. And then if you're a large company, so more than 250 employees and a turnover and balance sheet totals above a certain limit, then you can get a cash credit of 13% based on your spend. So clearly the SME scheme, very, very generous. And we see a lot of clients in the sort of Marcom sector making claims where they're looking at spending money on innovation, websites, new technology, etc. So there's two additional areas of expenditure that is going to be allowed now, which is if the company spends money on cloud computing costs or on purchasing data sets, which we're seeing as more and more common as amongst our client base. So that's good news. And I think probably the thing to pull out from this is at the moment, there is no sort of territorial regime based on the R&D. So you could be a UK company with a few employees in the UK, but potentially offshore all of your R&D activity to, I don't know, somewhere a sort of lower cost area. Now they're going to look to change the focus to R&D carried out in the UK. Now we don't know any more than that. It was just one paragraph in the book of information that is published after the budget, and we don't have any more detail. But I think my feeling is that it's going to look in some way to restrict the incentives and try and give more incentives to companies essentially doing R&D in the UK rather than just incurring the cost here in the UK. Okay, can you move the next slide for me, please, Mike? Thank you. Okay, so nothing new on this slide, but just a reminder of where we are on capital allowances. So this is expenditure that businesses can get tax relief on in respect of sort of capital spend. And again, we're seeing amongst our client base a lot of clients coming out of COVID where maybe they've there's lots of opportunities now for them spending money on expansions. So we're currently at a rate without any tax reliefs over and above this in terms of the super deduction or AIA, which I'll come on to. 18% for plant and machinery. So that's your normal, I don't know, office furniture, printers, computers, all of that sort of thing. We get 6% on what's called a special rate item. So these are sorts of things that are in buildings. So your aircon system, your heating system, your cold water systems, cars that are not green. And then we've had around for the last couple of years a structure and buildings allowance, which gives businesses 3% on basically building new commercial property. Now, the super deduction, this was announced in the spring budget and has already been in existence for about six months or so. So this is a deduction that is available for companies only. So it allows you to have 130% relief. So you're getting an additional 30% on what you've actually spent for plant and machinery that would go into what we call the main rate pool. So this is your, like I said before, your computer equipment, your desks, tables, chairs, all of the sort of stuff that businesses buy on a regular basis. So we've got the super deduction for a 2-year period. The restrictions, as I say, is for companies. And then the other restriction on there, which I can't quite understand why it's there, other than to perhaps incentivize to maybe buy more new equipment to help stimulate the economy. But you can only get the super deduction on brand new items, not on anything that you're buying secondhand. So this is sort of where the annual investment allowance comes in. If you are buying something that's secondhand in terms of capital expenditure, or you are not a company, so a partnership, a sole trader, then you cannot get the super deduction. So the annual investment allowance, it allows you 100% relief for the first £1 million of expenditure in every year. Now, it was due to expire on the 31st of December this year. And without any extension, it would have dropped down to £200,000 for the year. But we've now got an extension to the 31st of March 2023 at £1 million. Now, the significance of that date is that the annual investment allowance, £1 million limit, and the super deduction all end on the same date, being the 31st of March 2023. So whether there will be some sort of aligning of the rules, or as Rishi likes to put it, simplification, we'll wait and see on that. Okay, so this is a bit of a niche point, but I think the relevance of this, and we'll come on to a couple of other bits shortly, is this is almost a levy, and what we've seen and what Mike's talked about earlier is we've got a social and health and social care levy that's coming in on dividends, the 1.25%. this is almost the same sort of thing. So it's an extra 4% tax, which will be reported on the corporation tax return for basically residential builders that build residential properties where they make more than 25 million a year. So this is really targeted at the Bovises and the very large builders. So they're going to have an extra 4% tax on their profits in excess of 25 million. And apparently that's going to be put towards cladding remediation. Now, I haven't seen the detail of it. As Mike says, the finance bill is out on Thursday, but there's lots of these duties now that are being put towards certain things. Now, whether they are actually ring-fenced or not, I can't see from the details we have at the moment whether this will be ring-fenced purely for the cladding. The health and social care one is specifically going to be ring-fenced for NHS and social care. Okay, so again, probably a bit of a niche point here, but very, very relevant, like anything, if it applies to you. So this sort of goes back to almost 20 years ago, where Marks and Spencer's set up in Germany, and they didn't actually do very well. They made lots of losses, and they decided to then close all of their stores in Germany. So what they said was, we've made all of these losses in Germany. We want to set those losses against our UK profits that we're making. And they essentially took the government to court and said, it's not fair. Under EU rules, there's a freedom of establishment and we should be able to offset our losses wherever we want. And basically they won. So there has been this concept over, and then it was legislated. So there has been this concept that you can offset losses in certain very, very niche circumstances of EU losses against UK company profits. The revenue have never liked it. I've had about 5 cases that have ended up going to tribunal, and they're still ongoing, where the revenue just keep fighting it because they don't like it. Now, luckily for them, post-Brexit, they are no longer bound by EU law. So they've been able to say, well, we never liked it. We still don't like it. So it's been abolished. But I know we are working with some clients still on pushing forward with these group relief claims. So if you've already got a claim in, or you think you can put a claim in respect of losses incurred by 27th of October, there's still the possibility to do that. Okay, again, very niche. So tonnage tax, this is for essentially merchant ships, an alternative tax regime. The only point here really to make is that post-Brexit, there's been some changes that are being consulted on with an alternative method to try and make the UK a really competitive place to do business. I think there's probably nothing more for me to say on that one. Okay, so re-domiciliation. So sort of, if we think about the theme of making, UK a really great place from a tax perspective to do business, I guess there's been there's been a lot of companies now that are potentially, looking to set up in Europe in some way. So let's say US looking to come over to the UK. Post-Brexit, they're weighing up, well, should we set up in the UK, or should we set up, for example, in Ireland or the Netherlands or Luxembourg, where actually they're part of all the EU trade agreements. They've got favourable tax regimes. The headline tax rates in all of those countries is now lower than the 25%. So there has been a feeling in the profession that some companies, when looking to set up, have actually decided not to set up in the UK. So what this is trying to do, and what Rishi is really trying to say, is we want overseas companies to be able to come to the UK. So yes, you may have made a decision to set up in Ireland or to go to the Netherlands, but actually what we're going to do is consult as to what would make it really easy for you to change and come to the UK, which might have been what they wanted to do to start with, but just the tax and regulatory landscape might not have been perfect. I guess for me, I would say, if you're already set up in Ireland or the Netherlands and you've made that informed decision within the last 2 or 3 years, I'm not sure what benefit there might be for multinationals wanting to come here. So whether the consultation is going to be offering some sort of cash incentives or lower tax rates for a certain period of time, I think it'll be interesting to see what happens with that. Okay, so this might apply to some of you on the webinar. So this, again, following the theme of a levy being introduced. So this is another levy. Again, it means it doesn't get added to the headline tax rate, so potentially goes under the radar, and again, very targeted at certain industries. So this is a levy that is going to be introduced from April next year, but with payment from April 2023 for any businesses that are regulated and in the anti-money laundering rules. So that includes firms like us, firms of accountants, lawyers, casinos, property agents, essentially anybody that falls within the AML rules. So the idea is if you're in it, so you part of the AML rules, then you're going to have to contribute towards funding economic crime reforms. And the government think it's going to cost them about £3 million a year to administer this, but they'll raise about 100 million a year. So if you're in this, you're going to pay a fixed fee based on what your turnover is. And I think for most businesses, which are between 10 million and 1 billion turnover, you're going to be paying somewhere between £5,000 and £50,000 a year, depending on where your turnover sits. So again, not an insignificant cost, but another tax rise under a different name. Okay, I think when this was announced, my initial view was, well, why haven't we already had this? So this is essentially the government clamping down on not people that are doing tax avoidance, but people that are promoting sort of racy tax schemes that might have been floating about, perhaps more so 15, 20 years ago than they are now. So at the moment, if you partake in tax avoidance, then you can have your assets frozen. You can be named and shamed on the Revenue's website. Monsoon were famously named and shamed a few years ago for not for tax avoidance, but for getting their national minimum wage calculations wrong. So now this is, the Revenue can do this for people that partake in it. They're now clamping down on the promoters, and it will take effect from Royal Assent of Finance Bill. So that will probably be sometime early next year. Okay, so this is sort of applies to the larger businesses, and what I mean by this is 200 million turnover. Now, what isn't clear is whether that is worldwide turnover at the moment or UK turnover. So again, we'll wait and see what is in the finance bill for that. It could potentially apply to more businesses than at first glance. So this is where, if you've taken an uncertain tax treatment, you basically have to tell the Revenue, we've done this, you might not like it, it's not completely clear, so you're signposting to them, please come and take a look at my tax return. It only applies for the larger items, so where there might be a 5 million potential tax advantage in a 12-month period. So again, this might be either where a business has taken a position but said, we're not quite sure about that, so we don't want to take the full benefit of it on our accounts. Or you might have applied to the Revenue for clearance to do something, I don't know, a reorganisation, a restructure, and the revenue has said, no, we don't agree with it. And, you know, you can still go ahead and do it. So if you chose to do that, you'd then have to write to the revenue and tell them that you've done it. So I think if anybody finds themselves in this position, then, you know, you're expecting a conversation from the revenue and a phone call very early on, I would expect. This is the one that I've had the most questions about. So online sales tax. So this was talked about, so it's been talked about for a long while, and in the weeks leading up to the budget, I guess, got a bit more interest. And all Rishi has said is that there's going to be a consultation done on an online sales tax. So again, is this another levy that will be introduced, keeping the headline rate still at 25%? And again, the idea that anything raised will be to pay for something else, so that there's a sort of cause and effect of this. Now, I don't know any more than what is on the slide. It was literally a one-liner in the announcement. So once the consultation is there and published, this will be of very wide interest to very many businesses who trade online. And in particular, I guess, you know, I'm interested in whether there will be a de minimis. It feels like there should be, that it's only if your sales are above a certain level that you should be paying this. Or if you've already got, let's say, a high street shop, or you've got a commercial warehouse that you operate from, and the online isn't the majority of your business. It feels like there should be some concessions for some businesses, but, you know, I don't have any more to add than's on the slide. So this was agreed in Rome on Saturday. So no real surprises here. Back in, I guess it was the summertime, it was all agreed at the G7 that there would be a 15% minimum tax rate for multinationals. Essentially, that was just signed off at the G20 on Saturday in Rome. Technical details are still being worked on. I dread to think how many extra tax books will be published and pages of legislation this will take up. And of course, there's still all the political hurdles to remain. I mean, one of the countries that were a little bit reticent, shall we say, was Ireland. They're currently at a 12.5% rate, which again, being so close to the UK, they've certainly benefited from a post-Brexit boom in companies looking to locate there. So they're keen to keep their advantage as well from a tax perspective. Okay, I'm going to hand over to you, Mike, and take a glass of water, I think.
Mel, there was a question actually on R&D on your section. It was about the, you mentioned that there's some R&D tax credit specifically relating to cloud computing. Yeah. And somebody's asked, is this just involved in creating a new solution, or does it support businesses just moving to off-the-shelf cloud computing services?
Okay, thanks, Esther. So this is companies undertaking some R&D that as part of their R&D, they have to incur costs in respect of cloud computing. So if you're, I don't know, let's say a manufacturer that just moves their system to the cloud, then that is just an IT decision. That isn't, you're not undertaking any R&D, you're just moving to a new system. Now, if you are, I don't know, a technology business investing in trying to create some new technology that does something that's never been done before, and as part of that testing of that technology, you have to incur some costs in respect of testing how it works on the cloud, let's say, then those costs can now be included in your R&D claim. So if you weren't making an R&D claim before, this probably isn't an opportunity to now make one. If you were making an R&D claim, it probably means that it's going to be a bigger claim because you can now include more expenditure than you previously could.
Thanks, Mel. And does the same go for, because I think data was included in there as well, wasn't it? So if you're procuring that data as part of an R&D exercise, then it may well be eligible. If not, then no.
Correct.
Yeah. Okay, thank you. And that was it on the questions on that section. So yeah, back over to you, Mike.
Okay, so finish off with personal taxes. It won't take long because there were not many changes, but we'll run through them such as they are. So just a reminder that all the tax allowances and tax rate bands, etc., have all been frozen basically for the remainder of this Parliament. So unless there's an actual positive act to change them, they're going to remain the same. So nothing different for next tax year compared to this year. No changes to capital gains tax, exemptions, rates, inheritance tax reliefs, etc., etc. ISA limits, they're all frozen, as is the pension lifetime allowance. That's frozen up until April 2026. So no changes at all there. One small change. If you sell a residential property and you're liable to capital gains tax, at the moment should I say before budget day, you had to report that gain and you paid the tax within 30 days of the disposal. So you did this independently of your self-assessment tax return. Well, the government are now allowing a bit more time to do that. So that's been extended to 60 days to make the return and pay the tax. And that applies to disposals on or after budget day. We know because Boris told us that we've now got an increase in national insurance. And this is coming into effect from the beginning of April next year. And employers and employees NIC is going up by 1.25% each. In the following year, they revert down to current levels, but don't get too excited because we're then going to have a health and social care levy of 1.25%. So we changed the name of it, which clearly makes it that much more palatable, or maybe not. So these are the movements in the rates. So this is for employment income. So the first line is the current rates of national insurance for the current year. And then the line below that shows the increased rates that will apply from next year to different bands. So that's for the employed people. For self-employed people, likewise, it's the same. So currently, the main rate of class 4 NIC is 9%, with 2% above the upper earnings limit. For the following tax year, those go up by 1.25% each. So it applies to the self-employed as well as to the employed. Not only does that rate apply to earned income and self-employed income, they've also increased the rate of tax payable on dividends by the same amount. And those are the rates this year and next year. So if you're a 45% income taxpayer, you currently pay 38.1% on dividends, and that will go up to 39.35% for the following year. It was thought, and certainly the opposition parties sort of said that this should have been extended as well, this 1.25% to the receipt of rental income, but no, it only applies to dividend income and earned income, and that's all at the moment. Pensions, there has been a couple of changes. One of these is probably worth noting if you're coming up to retirement. From the 6th of April 28, the earliest age you can access your pension will increase from age 55 to age 57. Currently, you can't access it under the age of 55 without incurring a penalty. So if you're sort of thinking about retiring in the next 6 or 7 years, you might want to bear that in mind. You can access your pension at an earlier age, but there is an income tax penalty if you do so. Having said that, there are a couple of exceptions to that. It is possible to have something that's called a ill health retirement, and that applies, but basically you're unable to work anymore for whatever health reason. And in those circumstances, you are able to take your pension at an earlier age without penalty. And then there are a few special cases, quite a few actually, and they're virtually all sports people. For example, professional footballers can take their pension without penalty at age 35 and onwards. So if you want to take your pension early, think about becoming a professional footballer. And if you're struggling to think about where you might play as a professional footballer, you might try White Hart Lane at the moment, because it seems to be in a bit of disarray there. Compliance, I'll just mention something on compliance very briefly. The government are actually going to allocate another 55 million to the revenue and their taxpayer protection task force. I mean, this is going to sort of focus on increased compliance activities, but also on recovering monies owed due to incorrect coronavirus job retention scheme claims. The CJRS worked really well, but I think it is well known that there have been quite a number of incorrect claims, some accidental, some not so accidental, and clearly that's somewhere where the government want to devote resources. And then the government are going to allocate another nearly 300 million over the next 3 years to tackle tax evasion and the shadow economy. This is to really tackle the tax gap, which the revenue estimate to be 35 billion. I don't know how they get to that figure. It must be just an estimate. If they know where it is, they ought to go and collect it. So I'm not sure how, I've always been a bit skeptical about how accurate that is. But that's a little bit on compliance, but I think the emphasis on compliance is forever cranking up. More and more resources are being devoted to it. So this is a continuing theme. Right, and then finally, as to intimated, as I'm due to retire, or partially retire, shall I say, next year, this may well be my last budget. So I thought I'd cast my mind back to the rates of tax when I started in the profession. So if you go to, I think I started in July 1977. So I was 1 month out of university. More importantly, 2 months after Liverpool winning the European Cup for the first time, which was a more significant event for that year, and Mel's shaking her head. But the tax rates for that year were really interesting. The highest rate of income tax was 83%. So for those of you who think 45% is high, it was 83%. But what is more is if you had investment income, in other words, dividends, rent, or interest, there was another 15% on top. Which made a total of 98%. So one of the things you might conclude from that is you wouldn't take dividends out your company and pay 98% tax. But they also had a regime called that to actually deem you to have actually paid dividends, even if you hadn't paid dividends, if you're in a company controlled by 5 or fewer people. And that was really penal. Capital gains tax was reasonable at 30%, and it was 30% for a very long time. Corporation tax was at 52% for large companies, and to be a large company, you had to have profits of over £85,000. Not exactly large in modern times, but the small companies rate was 42%, so still pretty high. The tax that became inheritance tax was capital transfer tax. That tax rate has remained the same throughout, 40%. Which is fine. And then finally, VAT was 8%, much less than now. So, you know, it was a different time, different era. The Chancellor of the Exchequer at the time, Dennis Healey, famously said, "I'm going to squeeze the rich until their pips squeak." What he didn't really appreciate is that the pips opted out of the country and they emigrated, a large number of them. So there wasn't so much squeaking because people decided 98%, that's not for me, thank you very much. So that's what it was. So if you're complaining about the tax rates today, they're not as bad as before. And I suppose I got accused of showing appreciation to Margaret Thatcher when I did this morning, but it was largely down to the Thatcher area that actually caused sort of tax rates to become a bit more sensible than they were back in the 70s. Back to you, Esther.
Thank you very much, Mike. That brings us nicely to 4 o'clock, and that was fascinating. I totally was forgotten how staggeringly high tax was. Well, we don't have any more questions, so I think we'll bring this to a close. And just to say thank you very much to everyone who's joined us today. Remember, slides will be sent. You should be directed to a feedback form. Again, please do fill that out. It's really useful for us. Enjoy the rest of your day, everybody. Thank you very much.